Welcome to Reverse Mortgages for Beginners. This is a series of videos I'm putting together for people who are in the early stages of learning about how reverse mortgages work, and you're attempting to find out if it's something that might work for you specifically. My name is Bruce Simmons. I'm the Reverse Mortgage Manager for American Liberty Mortgage in Denver, Colorado. My contact information is below. I'd love it if you give me a call with any questions, or you can visit me at my website, which is also linked below. But I'm going to talk about two questions that people have right from the start. Number one, what is a reverse mortgage? And number two, how do they work? First of all, there's different kinds of reverse mortgages. There's FHA insured reverse mortgages, which is the most common type of reverse mortgage there is, and that's the one we're going to focus on today. In future videos, I'll be talking about something called proprietary reverse mortgages, which are non-FHA insured reverse mortgage loans. But right now, that topic is off table. We're not talking about it. We're talking about the FHA insured reverse mortgage. And people always ask me, well, what is it? What is a reverse mortgage? It's an FHA insured loan that's specifically designed for people that are 62 and over. It allows you to convert a portion of the value of your home into money that you can spend however you want. You have to live in your home as your primary residence. You have to keep your name on title, pay your property taxes, your homeowner's insurance, and maintain the home. As long as you do those 5 things, you can never, ever, ever be kicked out of the house, and no payments are ever due on this loan. You never have to make an actual principal and interest payment. However, like I said, you do have to pay your taxes and insurance. The reason you have to pay your taxes and insurance is because the house stays in your name. The biggest misconception that people have in this industry is they think that the bank owns the home, and that's not the case at all. You still own the home. You can sell it anytime you want. You can paint it purple as long as it meets your HOA requirements, but it's your house. You do what you want with it. You just have to live there as your primary residence, pay your property taxes, pay your homeowner's insurance, keep your name on title, and maintain it. Do all those things and you never have to make a payment on it. Now we get into the second question. Well, how in the world does that work? How can I get away with not making a mortgage payment, right? You're still charged interest. Keep that in mind. Interest accrues on this loan. And I'm going to go into detail. I'm trying to keep it like at a 1,000-foot level here. In future videos, I'll be digging down around in the grass and we'll be getting all microscopic. We'll be going into the weeds on all this stuff. But right now, just know that the way it works is you're still charged interest every month on this loan. That interest gets added to your loan balance. So every month, your loan balance gets a little bit larger, larger, and larger. You're charged interest, but you're also charged mortgage insurance. That's something that a lot of people aren't as upfront about as they should. This is an FHA insured loan. All FHA insured loans, and FHA is the Federal Housing Administration, and on all FHA loans, they charge mortgage insurance. Mortgage insurance protects the lender. And again, this is another topic that I like to get in the weeds on. But in a nutshell, it protects the lender in case there's ever a loss on the loan. So let's say that your loan balance is getting larger and larger, but then 2008 happens again. Now your house value drops in half. Now your house went from being worth $500,000 to $250,000, but your loan balance has grown to $300,000. Well, what do you do in that situation? As long as you're living in the home, paying your taxes, paying your homeowner's insurance, maintaining it, and keeping your name on title, you don't do anything. You don't ever, ever, ever have to make a payment on this loan. And the lender can never come to you and say, hey, you've outlived the loan. You're done. You got to get out. No, that cannot happen. The loan only comes due if you don't meet one of those 5 requirements that we just talked about, or if you leave the home permanently. Okay, so if you pass away and you're no longer living in there because you're dead, that's not going to work anymore. So the loan comes due unless you have a spouse. Now, if your spouse is still on the loan and he or she is on title, then that person can continue to stay in the home. The loan continues on like normal. But then when you pass away, the heirs inherit the home. Or if you have to leave the home permanently, you can sell at any time. It's your house, remember? You sell it, you pay it off, you use the money from this left over after you pay off the reverse mortgage balance. Because I didn't touch on this, but basically the difference between the value of your home and the loan balance owed is still your equity. That's yours. If you sell the house for $600 and you owe $250 on it, you keep $350,000. That's your equity. If you pass away and you owe $300 and the value is $600, then that equity goes to your estate. Your heirs inherit the home. They sell the home, pay off the amount owed, and whatever's left over they keep. Or if they wanted to keep the house, they could keep the house and just refinance the loan. The bank only wants the money that's owed to them. Now, one key thing that you have to understand, like I mentioned before, interest is accruing, and so is mortgage insurance. So mortgage insurance, like I said, protects the lender in case you do end up upside down on the house. If you owe $300,000 and the house is only worth $250,000, it doesn't matter. You can continue to stay there. But what happens if you pass away? Now your heirs inherit the home. They have to pay the extra $50,000. Darn. No, that's not what happens. They do not have to pay that. They can sign the house over to the bank and walk away. The lender, or the bank, I use those interchangeably, but the lender will sell the loan or sell the house for whatever they can get for it, and then they'll file a claim with the mortgage insurance company, and I'm simplifying this to an nth degree, but they file a claim with the mortgage insurance company. The mortgage insurance company pays the lender, so because the lender is not losing any money, they're not going to come after you, your estate, or the heirs for any loss. You can never, ever, ever leave a debt beyond the value of the home to the estate. That's critical with reverse mortgages because nobody wants to do that. You don't want to be a burden to your family. You don't want to leave a burden to your family either, okay? And you will never do that with a reverse mortgage. The absolute worst case scenario is that there's no equity left. But one key point that I want to touch on is every month you're going to get this statement in the mail and you're going to see your loan balance getting larger and larger and larger. If looking at that statement is going to cause you more stress than the benefits you get from this reverse mortgage, so you don't have a mortgage payment anymore, that's woohoo, you have extra money, yay. If those benefits are not enough to overcome the anxiety that you feel about seeing that mortgage statement go up and up and up, don't look at the mortgage statement. No. You should not do the reverse mortgage. Just don't do it. I would rather personally, knock on wood, I've never had a customer or a family member come back to me and tell me they've regretted doing this loan. And I don't want you to be the first. So I make sure 100% that you understand how this loan works and how that loan balance grows over time. So my name is Bruce Simmons. You can reach me at the contact information below. I'd love to talk with you about your situation, run some numbers for you and see if it makes sense. Thank you so much for watching my video today. And